Welcome, welcome. It's the Jill on Money Show. It's Friday, May 6th. Oof, what a last few days there have been in the markets. So I was planning on making this just like sort of like 100%. Let's talk about the Fed, but we're going to have to talk about markets also. As we expected, the Fed did raise interest rates by 0.5 percentage point. And I'm going to play a little segment that I did for CBS Mornings. I was standing up in front of a monitor and there were beautiful glitzy graphics there. But what I wasn't able to do was to really talk about the consumer impact of rising rates. And you'll also hear at the end of this segment that I talk about how, hey, stocks were up by 3% after the Federal Reserve Chair, Jerome Powell, conducted his press conference. And I think part of that was so interesting because I was watching the markets rally. I'm like, why is the market rallying? When investors seem to be delighted with the idea that the Fed chair kind of took off this idea of a 75 basis point increase, that he kind of took that off the table, 0.75%. But he also said something that I thought was really important that seemed to be forgotten in that glee over no 0.75% increase. And that is, he said, the Fed's going to really try to do this softish landing, really going to try to figure out how to balance the idea of raising interest rates without driving the U.S. economy into a ditch. He sort of used this term softish landing. I mean, that's pretty interesting. This is still going to be really hard, right? This is the metaphor I'm going with. The Fed is trying to gradually increase rates and slowly allow the bonds that they purchase, that quantitative easing, they're going to slowly allow those bonds to mature and roll off their balance sheet. Maybe they'll sell some in the future. This is their effort to kind of tap on the brakes, not slam them down. So again, this is the idea that the Fed is driving the car, the U.S. economy. It's part of the car, not the whole thing. They don't want to pull up that emergency brake, veer off the road, and then we're landing in a recession ditch. That's what they're trying to avoid. I think what the fear has been among investors, as we've seen in the first 4 months of this year, is that we are going to land in that recessionary ditch. So let's play the segment, Mark. We'll put the segment out there, and then I'm going to come back on the other side and talk a little bit more about markets, but also about the impact that I'm seeing right now with the Fed's action. So here is the segment yesterday morning. And when you hear a conversation and when I toss back and forth, it's with Tony DeCopel, who's one of our anchors. So here's yesterday's segment from CBS Mornings.
The Federal Reserve has announced the biggest increase in its key short-term interest rate in more than 20 years. That rate going up by 0.5 percentage point, all part of the battle to rein in prices, which, of course, have been rising for most Americans. I mean, take a look at this. Since March of last year, the cost of food, energy, and gas have all seen major increases. So the big question is, will the Fed strategy work? CBS News business analyst Jill Schlesinger is here to tell us. Jill, good morning.
Good morning. Well, this move was expected, and it's intended to thread a very precise needle. We're trying to see if the Fed can ease prices without triggering a recession or job losses. Now, that 0.5 point increase for short-term interest rates, the largest since the year 2000. And it aims to do two things. One, we were going to see if the Fed can remove the economic boost that they provided during the COVID recession. And two, as we've been talking about for a long time, they're trying to fight inflation. And that inflation rate is increasing at the fastest pace in more than 4 decades. So this hike means you may see interest rates rise on everything from credit card balances to new auto loans, adjustable rate mortgages, even some small business loans. Good news, investors cheered that the Fed is going to be able to execute this strategy, that it's on target after a brutal April. And we all felt that brutal April. And early losses to begin the day yesterday. All 3 major stock market indexes soared by roughly 3% on the session. So, Tony, good news. You can stop texting me and you can actually check your 401k statement.
That's right, because I want to retire tomorrow.
Exactly.
Not quite time yet. All right, so that is the Fed strategy. I understand that now. How quickly could it work for people?
Well, it will start to work within months, meaning that it will mean that the inflation rate will stop going up. But prices are going to remain high for probably 6, 12, maybe even 18 more months. The Fed strategy is a 2-year strategy, and we're just at the beginning of this process.
So it went up relatively slowly to a new high, and it's going to take some time for it to come back down.
You betcha.
Okay, so you hear me say to the anchor, hey, you can check your 401k statements right now is what I should have said, because as markets opened yesterday morning, it was just all downhill. And it was a really rough day. So as I record this, it is 12:40 Eastern time on Thursday, and looking like 3.5% losses for the broad indexes, 5% loss for the NASDAQ. It's ugly out there. So what's changed? Nothing's changed. We are still in the exact same situation that we were in. Investors seem to be really struggling with the idea of how will stocks perform in this new phase of the Federal Reserve raising interest rates, and also all these other unknowns which have been existing for now months. The supply chain, the war in Ukraine. This kind of reminds me a little bit of the Great Recession and the financial meltdown, that we hadn't been through a period like that. And so the fear of the unknown was what really caused so much of the selling. And we just don't know, because frankly, nobody really can understand what the path forward is. So let's take a deep breath for a second and let's remind ourselves, why do we invest? We invest for the long term, right? You know that. We've talked about this for a long time, talk about long term. And, I think that there are a lot of people who are worried because there's kind of no place to hide. Stocks are down, bonds are down, you're getting paid piddly squat on your cash. I get all of that. But for many people, and I would say for the vast majority of us, we are investing for the long term. The long term meaning you are looking at maybe your own retirement, maybe college funding. And even if you're about to retire, you've got to remember that your retirement is going to last 20, 30 years. The thing that I always try to soothe myself with is that, if you remind yourself why you are investing, that you're saving for a long-term goal, or that I'm still putting money into retirement or my college plans or a brokerage account, that money is coming out and now buying shares at cheaper prices. I mean, given that we are at 40-year highs in inflation, there aren't a lot of sales out there. And so when you get the stock market, the bond market dropping, you're essentially able to buy many assets on sale. Does not guarantee that they will not go lower, but it does start to make you consider that in some ways you are combating this very uncertain period by sticking to your game plan. And to me, I think that sort of always gives me some solace. Okay. Some more things to remember. We've been talking about the Fed. We've been talking about why the Fed does what it does. But, listen, remember that if you've got credit card balances and auto loans and adjustable rate mortgages and small business loans, those are all going to cost more. Savers, and I think a lot of you are savers, you go look for those higher rates with the online institutions. They're much better than the brick and mortar. Do check out I-bonds. Mark said he was going to go to treasurydirect.gov and fight with that website to grab that 9.62% I-bond rate that is going through October. And if you are looking at mortgages, if you can still afford your house with a 5.5% mortgage, that's fine. I know many of you might be choosing a variable or adjustable rate loan. That locks you in for a fixed period, sometimes 5-7 years. Just be careful, because there is a risk that rates could be higher whenever the period is up. So, I think that some of this period should remind all of us that we are not immune to volatility. It's not just that we go through a horrible period like the spring of 2020 and come out of it and say, oh, that's no big deal. It's always a big deal. It is always anxiety provoking. It always makes you feel a little worried. You start second guessing yourself. All those things are true, okay? I get it. So what I would like you to do is, if you're feeling breathless, if you're feeling worried, if you're feeling anxious, why don't you give us a holler? Just go to our website, JillOnMoney.com, click the Contact Us button. Let us hold your hands. Let us do what we do best, which is coach you through some of these really tough decisions and some of the more difficult periods that we're all facing. Okay? JillOnMoney.com, contact us. Let us know if you would like to come on the air, because we'd love to have you. Okay? All right. So it's Friday. It's another day. We are going to have a jobs report. Let's see what that shows. Probably maybe about 400,000 jobs or so. We'll see. And let's not get too wrapped around the axle when we're thinking about our car, the U.S. economy. Okay? Good. All right, it's Friday. Let's do some business. Our music is composed by Joel Goodman. Mark Talercio is our executive producer, the best one in the world. We are distributed by Cadence 13. Do us a favor, if you wouldn't mind. On this day, when things are always feeling a little bit wacky, do something nice for someone else today. And maybe that just means putting your hands metaphorically on someone's back, shooting a text to someone. Check in with people. People are a little unnerved right now, okay? Grit, growth, grace. Thank you for listening, and we'll talk to you tomorrow.